Hi, this is Greg Sierra again with example number 1 from the pension lecture note. So you have a bunch of facts, and it asks first to calculate the beginning of year pension asset or liability. Up in the information, you have the PBO and the plan assets. The net amount of those two is the pension asset or liability. So 737 is greater than the 613,480. This is underfunded, which is an actuarial term. So it also means that this is a pension liability. And in part A, we see the calculation of the difference. Once again, because the obligation is greater, it results in a liability. Now for pension expense, this, first of all, I want you to identify that this OCI, really it's a balance, it's AOCI. Let me draw that a little more clearly. AOCI accumulated, other comprehensive income. So this is a balance. The service cost, and here are the components of pension expense. Service costs, interest costs, amortization of prior service costs, added. That is debit, debit, debit. So those are all increasing pension expense. The actual return, which happens to be the expected, you'll see why it makes, this is just a basic problem, makes it a little bit easier to start with. This could be plus or minus. So it could be a debit or a credit. So a positive actual reduces pension expense. And this one is a positive, okay? That's a positive return. The contributions and the benefits paid, they're important to pension accounting, but they're not part of the pension expense calculation. So once again, service, interest, and amortization of PSC for prior service costs, and minus a positive actual return. Add it all together, pension expense is $82,000 for the year. Service costs, interest costs, amortization of prior service costs, actual return, and then we're going to see the last complexity of it's going to be asset gains and losses, but we're not dealing with those yet. And with respect to the journal entry, this is the pension expense adjusting journal entry. So clearly the pension expense is going to be debited. So the 82,000 goes down here. Where does the cash come from? Contributions. These are also known as funding payments. $57,000. These will always be credits because the company is, so the company is sending cash to the pension plan. All right. OCI prior service cost. So this amortization of prior service cost right here increases pension expense, decreases accumulated other comprehensive income, prior service cost. So it's easy to forget that amortization part. Amortization is a reduction. The AOCI prior service cost has a normal debit balance. So it started with, what was that balance up there? 83,000, normal debit balance. And then you're going to post this $17,000 credit to it. And living life on the edge, what is that? 66,000 is the ending balance. Okay. So you put 82,017, and then this becomes your plug. which is you started with a liability, you're adding a credit, so you're going to end with a larger liability. In pension accounting, you could start with a pension asset, end with a larger or smaller pension asset, start with a pension asset, end with a pension liability, start with a pension liability, end with a larger or smaller pension liability, or start with a pension liability, end with a pension asset. Don't try to pre-guess where it's going. Just go through the process, credit the pension asset / liability. So right here, let's use T accounts. So we have a pension asset liability. In this case, it's actually a liability, but we're just saying pension asset liability to keep it complete. And where am I? Right here, we started with, to remind ourselves, we started with 123,920. So we started with 123,920, liability, 123,920. We add another credit, and you end up with 131,920, pension liability. All right. Once again, if it's a pension liability, the actuary says this is underfunded. You have more obligation than assets to pay them off. So that's example 1 from the lecture note.